So today's April 8th. I want to give you some updates on the stock market and some of the trades that I'm making. If you want more information on here, I do have a longer form video. You can check that out as well. If we go back to prior data, effectively when we had the 2007 through 2009 crash, we lost about 57% of the S&P 500 value. When we were looking at 2020, basically it lost 34%. If you were looking from the end of 2021 through third quarter of 2022, lost about 25%. If we're looking currently at the S&P 500, it has dropped 18% through April 4th, and April 8th we're now at about 19%. So let's apply that to the current situation. We have tariffs that are going into effect. Some of them started on April 5th for about 10% on most imports. There was some additional tariffs that were put on to steel and aluminum before this, but tomorrow, April 9th, is the last day before the increase for the tariffs on all of the named countries. We're looking at tariffs of 20% for the European Union, anywhere from 34% or higher than that for China, Japan at 24%, Vietnam at 46%, South Korea at 26%, and then we have Taiwan. This is where about 95% of all 5 nanometer computer chips come out of. So this is very important for anything like a cell phone, a computer, things like that. We're going to have a tariff of 32% of all those components coming into the United States. India is at 27%. So all of these are going to increase the price of the goods that you purchase, which also adds to inflation. So that's a concern. If these are not changing, I don't see us getting out of more pain in the market. So on April 4th, I made a prediction. Basically, I was saying that we're likely to see more than a 25% loss in here. April 8th, we're now at about 19% loss. And if you looked at 25% loss, you would see about a 460 price for the S&P 500. If you were saying it's something worse and it's similar to 2007, 2009, that's 57%. If you're looking back to 2000, 2001, that's about 49% loss. But effectively, if you went down to 57% loss, you're looking at about $263 a share. So that's kind of where my head is at right now. I think it's going to go to 460, potentially lower. So the only thing I can see that's really going to change this is if there's negotiations or if tariffs are paused or stopped. What am I doing with this information? Well, I'm still dollar cost averaging. Basically, the S&P 500 is on sale. The international funds, I always put about 10% in there. Sometimes that outperforms the S&P 500, especially if you have a problem in the United States, but you don't have a problem outside the United States. So this is mostly going to impact the S&P 500 and have a little bit less of an impact on international stocks, or at least the companies that are selling goods. I'm now buying bonds with that last 10%. Before, I was kind of out of bonds because I wasn't seeing really any movement in interest rates. But if we hit a recession, which is basically first quarter GDP estimated by the Atlanta Fed is now negative. If we get 2 quarters of negative growth, and if we have tariffs, I'm pretty sure we're going to have negative growth because the cost of things are going to go up. People tend to buy less things. JP Morgan is putting in a 60% chance of recession in 2025. Poly markets are about 60% chance of recession. Because we may go into a recession, the Fed has a dual mandate. Effectively, they have to keep maximum employment and they have to have price stability. So if they're looking at a 2% target, we're already above that. They can't really make any changes, but if people start losing their jobs in the hundreds of thousands or millions a month, what they're going to end up doing in many instances is have quantitative easing, have reduced interest rates. The government may pump out stimulus checks to help all those things effectively prop up the economy, make consumers spend money. And when people start spending money, then basically businesses will hire more people to make more products because people are buying those products. So that would be the hope. So if they drop their interest rate, bonds move inversely to interest rates. So bond value will go up generally, and the yield on a bond goes down. that's why I'm starting to buy bonds again. TLT is 20-year bonds. I have call options for 2027. I also have basically something that's tracking the VIX. The VIX is a volatility measurement. So basically when people are fearful, volatility goes up, VIX goes up. And when that happens, I tend to buy UVXY. I've only really done this in February and March of 2020 when I had over a 400% return here. And right now, I bought it at about $21 to $24 a share, and then I was buying a little bit since then. But effectively, it went to $41. Now it's at $47.69. It's up over 98% since I bought those shares. So that's a fairly decent return. This goes up and then it comes down like a knife, so you don't want to catch it. So if you don't catch it as it's coming down, you lose a lot of that value. So what I do is I employ a trailing stop of about 30%. So when this comes down very quickly, I don't have to watch my computer. It just does it automatically. That's the only way I can really trade on UVXY. So I would say that this up here is called investing. And all these options and some of these higher risk assets, this is speculation. This is close to gambling. So there's no guarantees in any of this. But that's what I'm doing. I have a 98% return thus far on this. And if I have a 30% trailing stop, I would assume that I'm at least going to get around 70% return if it started dropping tomorrow. Other thing I'm doing. So today I bought SPY put options. I had a strike price of $500 a share effectively. The expiration is June 20th of this year. And the cost I paid, it's pretty steep, $25.50 a share for 100 shares. So that's $2,500 for that trade. And then within the same day, it's now at $30 a share because I kind of caught it on the dead cat bounce. I was seeing as it was going up, I'm like, I don't think that this is going to stay. I think this is going to come back down. I was very glad I did that. So got $30 a share and it's already at 17% return for the day. When I'm looking at this, I'm looking at put and call ratios. So right now, if you're above 1, it means there's more puts. More people are thinking the stock is at risk of falling compared to rising. So the puts to call ratio, I'm seeing about 1.7, 1.9 put to call ratio. So that's pretty bearish. We saw this again in August of last year, basically when we saw a pretty significant drop in the stock market. And then we also saw this at the end of 2021 when the Fed was about to start raising interest rates. And then we had a negative return for, minus 25% over that period of time. It did bounce back. When we had this high put to call ratio, it was indicating we were likely to go down. So what we saw in the last day or so is effectively we saw the stock market go down to about 484 a share, went up to 523 a share, and then came back down to 496 a share. I would consider this a dead cat bounce. People are like, what does that mean? So this is kind of morbid, but the reason why they call it a dead cat bounce is effectively no matter what you have, if you throw it hard enough and fast enough down to the ground, effectively it bounces off the ground. So this is basically, we've been dropping so rapidly, people were trying to get in thinking that it may reverse, and that caused that to bounce a little bit, and then we went down further again. It's really only something that you could see in retrospect. But that's what I was hoping it was as I was going in, and it's kind of funny because in my head, as it's going down, I'm like, great, I'm a genius. And then it bounces back up, like, oh no, I'm a moron. And then it goes back down, you're like, I'm a genius. So try to make sure you have steadfast emotions when you're going through this. If you're choosing to do this, make sure you have a good rationale for whatever decisions you're making. And regardless of all that, I'm still about 80% in the S&P 500, but I effectively have downside protection on a lot of my shares. So as now it's below $500 a share, I'm protected at $500 a share. So it doesn't matter how low the stock market goes, I'm always going to get $500 a share for those 100 shares for each of the options that I purchased. And when I'm investing, just realize that I have at least a 6-month emergency fund. At this moment, I have well over a year of emergency funds. So if anything happens, I don't need to pull anything out of the market for over a year. Even if I lost my job, I could live off that money. And besides the emergency fund, anything that I need in the next, say, 5 years or less, that's going to be in high yield savings, CDs, anything that is FDIC and up to that limit of protection, about $250,000 per account. And any of the money that I don't need for, say, 10, 20, 30 years. In those instances, I'm going to put that in stocks, market, some of these, inverse ETFs and all that stuff, but most of it's going to be the SP 500, 10% international, some bonds, and maybe a 1% in UVXY, and another percent in maybe some put options and things like that. But I don't want to have a lot of high risk things in my portfolio. It's really only about 5% or less are really high risk. Why do I want at least 10 years? Well, you may have instances where you lose 57% in the course of a year or two, and it may take 10 years for that to recover. So that's the reason for that. So if you enjoy this type of video, I have a lot more content on here on how to make money, how to save money, how to invest, and also how to be an entrepreneur. I start other businesses, and I have a lot of videos here where it shows you how you can start a business with less than $1,000. Thank you for watching. Please subscribe and have a great day. Good luck.